We're here with Steve Milch, an economist, former chief economist and now economics teacher at the university level. And we're going to be talking about fiscal policy and the federal budget for 2020, which just came out this week, depending on when you'd be watching this. But Steve, thanks a lot for coming on board. Do you want to just give a little bit of a preamble about some of the things that you've done and where you come to this from?
Yeah, of course. I think those who know me know that I think I got economics in my blood somehow during high school. I've loved economics ever since high school, ever since many of you listening doing HSC economics, and I've spent my career pretty much as an economist, also in investing, but economics has always been at the heart of it. Chief economist at St George Bank, then chief economist at Suncorp. And now, as Alex said, very much enjoying passing that love for economics onto the next generation, today's students, in the hope that I can inspire them the same way I was inspired. I'm loving teaching, so it's a lot of fun.
Well, good to hear. So something that I've been talking to students is that every year the federal budget is handed down in May, except for 2020 because the world has gone crazy. So we got the budget in October, which was a very unusual event. Can you talk a little bit about why the budget was pushed back? Why are we talking about, the Treasurer getting up in October rather than May?
Yeah, really interesting. Here we are in October talking about the budget, and I remember many years in May, always a Tuesday night in May, I think normally the second Tuesday in May, staying up late at night to study the budget and writing about it for clients and so on the next day. And here we are in October doing the same thing. Look, I think what happened, the reality is in May, all of our lives, not to mention the government's finances, were probably in a state of almost chaos. COVID, of course, struck around March. The government, to their credit, and I think this is a theme that we can come back to, but the government, to their credit, very, very quickly, as did the RBA, realised the severity of the situation. For many, many years from the Liberal government, we've been hearing about this quest for a surplus, and in fact, I think if we go back to the beginning of 2020, they were actually proclaiming we're now in surplus, and maybe briefly they were. They very, very quickly realised the severity of this situation, and they already, back in March, started implementing programs, JobKeeper, JobSeeker, that we all now know about, and have been actually, I believe, very effective. But they weren't in a position, they didn't know how deep this was going to be, how rapid it would evolve, and I think they probably made the prudent decision to delay the budget, wait for a little bit of clarity. Now we're almost 6 months later. We don't have much more clarity, but I think we've got a bit of clarity, enough for them to make some plans. So unusually, this is the budget for financial year 2020-21, and we're already 3 or 4 months into that year.
Right.
So it's funny that you bring out a budget, 1/3 of the way through the year, but such is the way they're doing things this time.
Yeah, I think that's a really good summary of it, because we were talking about how for the 1920 financial year, the forecast was for a $6 billion surplus, I think, or thereabouts, and that became an $86 billion deficit just for that financial year, right? So we can understand why the government might want to wait and see in terms of what its spending would be like, but also what the revenue might be like, because the income tax revenue, company tax revenue, falling off a cliff due to the impacts of the virus. So looking at it from the spending and revenue side as well.
Yes.
In terms of what we saw in the budget last night, do you want to give us some of your kind of highlights, some of the key things that the government did that you think are important?
Yeah, for sure. And maybe just also, it's probably worth mentioning that we didn't go from last May to this October without any budget updates. They did do a budget. They did do a budget update in July, but it was brief and relatively sketchy. So we got the budget last night, and here we are with a deficit of in excess of $200 billion, or 11% of GDP. So, in the old days, first of all, only less than a year ago, we were probably around that balanced budget level, maybe small surplus, maybe small deficit. And we always thought a budget deficit of, say, 3% of GDP was fairly significant.
Right.
Here we are at 11.
Yeah.
And to their credit, and Australia has been very fortunate right through the GFC to today. We never had a recession during the GFC. We've had continuous growth. We got to almost 30 years without a recession from 1991 to 2020. All of that means our budget position was actually in relatively good shape.
Right.
Going into this.
Yes.
And the government very quickly changed its almost ideological stance around surpluses. They said we need to spend, we have the ability to spend, and we'll talk about government debt. I think we need to come back to that, because our debt levels weren't high, and there's a very nice chart we can talk about too in the budget pack. So they very quickly changed tack. They've spent hard, to 11% of GDP, which really, I went back and looked at my economic history books, which go back to the 1940s. We have, certainly in dollar terms, we've never been at this level. Percent of GDP, maybe we have in wartime or depression time, but it's before most records.
Yeah, okay.
So what have they primarily done overnight or last night in terms of this budget? They have, I think probably the big measures are bringing forward of income tax cuts, and that has come in for a little bit of questioning around how effective that will be, because of course tax cuts can be saved or spent. Yeah. We've seen more cash payments going to those on social security and so forth. We've seen a big wage subsidy program launched, which looks very interesting, around getting young people, I think people under the age of 35, back to work. The government will top up or subsidise those wages. We've seen extension of tax incentives to get businesses investing. Again, there's some question whether a business would invest in the absence of demand, no matter how attractive the tax situation may be. Other things like accelerating infrastructure and more on the tax front. But the big ones are probably the wage subsidies and the income tax cuts and the investment incentives.
And if we look at those kind of things, we look at tax cuts, the payments, the wage subsidy, the investment, that these sound a lot like targets towards aggregate demand. That in terms of the tax cuts, that here you go, please spend this money. In terms of wage, the payments, here is money in your hand. The wage subsidy, getting people employed to be earning that income. And then investment, obviously another component of AD. So it seems like, together with some of the previous things, that it really is trying to put some kind of support and even supercharge under demand in the Australian economy.
Yeah, absolutely. So if we think in terms of our aggregate demand, aggregate supply model, first of all, we're going to be well below our full employment level.
Yes.
We've got unemployment today of the order of 8%. Or 7%. And yes, their intention is to push that aggregate demand curve to the right and try to get us back. It's going to be a long time before we're back at full employment, but look, try to get us back to that potential GDP or full employment kind of mark. That will take years. That will take quite some time, because the recession, that's another thing we haven't mentioned yet. The magnitude of that fall in GDP in the June quarter, I think it was -7%, was extraordinary. So we're a long way from full employment. We're trying to shift that aggregate demand curve to the right. But again, a lot of those incentives rely on giving money to consumers, households, or businesses, in fact, and seeing what they do with it. If they choose to save it, there's not much multiplier effect going on. If they choose to spend it, it can be very effective. We do have one good historical precedent
Okay.
And during the GFC, under Kevin Rudd, there were cash payments made to households, and I believe that, plus there was a school building program, those two things combined actually helped us avoid recession. So we're not going to avoid recession this time. That's already a fact.
True.
But at this point, I think we're weathering it better than most other economies.
Just back with that point in terms of what will people do with that money and the multiplier, that what I think you're referring to there is that when when people spend money, that it is not spent once and then that's the end of the story, that it is circulated around the economy and each time a little bit is lost or taken out. But the question there is kind of like, what is the marginal propensity to consume of all these people receiving a tax cuts? Because, and you can correct me if I'm wrong, but during times of economic distress, people tend to save. People are a bit worried for the future, and that making large-scale purchases are not always at the top of their list.
That's exactly right, and we saw it in the last GDP data. The savings rate spiked higher. So exactly, at times of uncertainty, people take the most conservative or prudent approach and save. So the question becomes then, why would you, if your goal was to stimulate, why would you just do it by handing out cash rather than? And some of the critiques that I've read today in the newspaper, for instance, Ross Kittens did a great article, and he said, look, there could have been perhaps more effective programs. Like one of the things we're aware of around Australia is that housing is unaffordable for many people. They could have launched a large-scale public housing construction scheme. That's possible, but again, those things take a long time to plan and get off the ground. So maybe it wouldn't serve what really is now a short-term need. Another one is, many nations and the IMF, in fact, are seeing this as an opportunity for governments to invest in green energy.
Right.
To take an active role in and it's obviously serves two purposes at once: stimulates demand and addresses climate change and so on. The government could have actively launched programs like that. They've chosen not to. They've chosen kind of a choice-based approach. Let all of us make the choices around what we do with our cash receipts or our lower taxes and see how that goes. I think it'll be reasonably effective.
In terms of the measures as well, that in looking at that sort of the wage subsidy program, that something that we can find tricky with HSC economics is distinction between macro and micro policy. Yes. Right? That in terms of this wage subsidy, would you see this as being mostly aggregate demand, getting people into the labour market? Do you think there are kind of micro elements in terms of structural unemployment and getting these people back into the labour market?
I think it's probably a combination of supply side and demand side.
Okay.
So to the extent that let's say this wage subsidy is effective and an employer takes someone on as a result of that, that person now has an income to spend, and that lifts aggregate demand. Now I'm not exactly sure of the details on this, but I assume it's going to take the form of payments to the employer.
Yeah, right.
So it reduces the cost of taking on that employee, and it may actually shift the supply curve to the right as well in our aggregate demand, aggregate supply kind of model. So it's probably a combination of supply side and demand side, but both working in the same way, both working to increase output and increase employment.
Yeah, okay. In terms of let's talk a little bit about debt, because this stuff doesn't happen for free. In terms of you looking through the numbers of what government debt is likely to be, what has stood out for you? Yeah,
so I think the first point to note is because we have been we had that very long period of uninterrupted growth.
Yeah.
So we didn't have any real budget crises over the last 20 years, which means our debt levels were relatively low. Very low, in fact, in a historical context. So what I've got here, looking at the table in front of me, I think we were intending to peak around 20% of GDP for government debt. We're now going to be, a couple of years from now, well into the 40s.
Yeah.
So we've doubled it.
Yeah.
But there's a couple of big, and on the surface that sounds a little bit scary, but there's a couple of reasons not to be overly concerned about that. One is that, and there's a terrific table in the budget papers.
Okay.
There's economic and fiscal outlook statement. I think it's statement number 3, and it's towards the back.
Okay.
Anyhow, there's a chart that shows where we stand in relation to the range of other nations. And we're right down the bottom. We're almost the lowest.
We're even with 40%.
Even at
GDP.
40%.
Right.
Even at 40. So we
Right.
were the lowest and we're still the lowest because everyone's pursuing this kind of fiscal expansion strategy. That's number one. Number two is that bond yields have fallen dramatically. So bond yields are the cost
Of borrowing.
of government borrowing. So the funny thing is, despite this massive increase in how much bonds it has to issue to fund that deficit, the actual cost of servicing that debt, and I don't want to get too technical, but the cost of servicing that debt is no more than really it was projected to be.
Right. So that because the interest rates are so low that the interest repayments on the loans are not actually going to be higher than was forecast originally.
Exactly.
Right.
So one, if you like, the increased quantity but the reduced price have offset each other, which is good for today. The question becomes down the track, if those rates were to rise, the impact that would have on the budget. But I think for the moment, it's a sensible strategy without being excessive kind of strategy.
Right. So a question that the government might ask of critics is what's the alternative, people? Like what would you prefer us to do in terms of policy? Is it that we don't spend as much and concede a higher rate of unemployment? I think that there will be ongoing debates about how much debt is too much debt. But that what I'm hearing from you is that the government had to spend on a large scale to offset the size of the recession and the risk of it continuing to a larger extent.
Yeah, and what we do know is this is unfortunate, but we're studying the economy in an unfortunate time, and it's a very interesting time. One thing we do know is that if people become unemployed and they stay unemployed for a period of time, 6 months, 12 months, and up to a couple of years, it becomes extremely hard to get them back in employment.
Right.
And the government wants to avoid that as much as possible.
Because we would be seeing, say, cyclical unemployed become long-term unemployed, become not even counted as unemployed because they stop looking for work.
Yeah. And the cost in terms, the personal cost and the economic cost can be huge. So they want to avoid that. I think they've had to tread a balance between, getting us back to work, getting the economy moving, and still pursuing, sound, responsible fiscal policy. And I think they've probably struck that balance pretty well. None of the criticism today I've heard is around the size of the deficit or the debt. The only criticism I've heard is, are the measures that they've taken the right measures?
Right. Are they going to be effective enough in terms of stimulating the economy?
Yeah, and I think the answer to that is they had to do stuff that would work quickly. So these tax cuts, for instance, first of all, they're backdated to July 1. And I believe the opposition has said they will pass them. So they will be passed in a matter of weeks. So, as soon as pay periods in November, people may start seeing cash back in their pocket.
Look, I think that we've talked very much about this movement from a kind of a contractionary, budget surplus arrangement to now being highly expansionary. Just because I know you're a keen watcher of the RBA, where does this kind of leave monetary policy, which has been expansionary for some time, and right now, as of October 2020, 0.25 of the cash rate is. What do you think the story is in terms of monetary policy in this situation?
Well, it's really interesting. There was some speculation, in fact, that the RBA would do something yesterday also.
Yeah, I saw that.
Yeah, they didn't. And I think at least one of the reasons they didn't is because one of the whole points of easing monetary policy is to announce it and get word out there and make people aware that, you know, rates have perhaps been eased and go out and borrow. And if they had done something yesterday, that would have been lost in the media around the budget. So that's probably a non-economic reason for not doing anything yesterday. But I think monetary policy with a cash rate of 0.25% is almost maxed out, I would argue. There is some speculation they could go lower, maybe to 0.1%, maybe negative, although Governor Lowe is on the record saying he would be reluctant to go negative. And there's a lot of questions around the effectiveness of negative rates. So I think, look, we may see more fine-tuning. It would only be fine-tuning, I think, of monetary policy. I don't think there's any big announcement or big initiative that they can come up with at this point. So we're at a really interesting time for policy. Monetary policy is maxed out, probably after today's budget.
Right.
Fiscal policy is maxed out. I think one of the big, in the decades to come, there'll be a lot of emphasis on on the supply side. So, you know, we saw a couple of weeks ago a initiative around the NBN to convert from copper cable to fibre optic cable. Initiatives like that get the economy moving, get the economy maybe more efficient, and I think that'll be the direction of policy.
And just in terms of supply side, so there we're talking about focusing on output firms, production, getting that kind of moving as opposed to that more short-term aggregate demand focus. So sort of macro on the AD side, but you're talking more long-term microeconomic reform, changing the structure of the economy.
Yes, creating incentives for people to do business, for people to work more effectively, making our economy more efficient. It's tough, but it's kind of the work of organisations like the Productivity Commission, it does get wrapped up into fiscal policy announcements a little bit, but I think that'll be an area of focus going forward. How do we become a more productive economy rather than just stimulating through interest rates and stimulating aggregate demand?
Right. How are we actually able to produce more output with what we've got?
Yeah. One example that I've been thinking about for many years now is, why don't we have, say, a fast train going from Melbourne all the way up to Brisbane via Sydney and Canberra?
Right.
Something like that would be an enormous productivity boost for the economy, get people moving quickly and efficiently. There's probably many reasons why it hasn't happened, but those kind of initiatives.
No, I understand. Look, Steve, that's been very detailed. We might leave it there, but thank you so much for your time on this.
Thanks so much, Alex, and to everyone listening, good luck. Good luck with your studies.
Thank you.